everybody, good evening. You know premium equals base plus 1 year term plus PUA. Can I discuss structured versus unstructured PUAs and how these are used in policy design? Okay, I think you mean scheduled and unscheduled PUAs. When it comes to some insurance companies, they give us the ability to contribute on a schedule or unscheduled. When we make our payments, we either make our payments on a set time frame, or we can dump in money whenever we want throughout the year. With whole life companies, Guardian allows dumping in whenever we want throughout the year. Mass Mutual, Penn Mutual do not allow that. They have set time periods where we can put money in, typically our anniversary period. These are companies that want to know how much are you giving them each year. Guardian, they're really flexible. They basically have the flexibility of an IUL. Your IULs, you have the flexibility to contribute on a set schedule of whatever amount you want to be tied to, and you can dump in up to the MEC limit whenever you want throughout the rest of the year. Same thing with Guardian. So we can do those things with certain carriers that we can't with others. So that's the difference between scheduled and unscheduled. Scheduled, we tell the insurance company when we're going to give them money as new premiums, and they're going to expect it on that time frame. Unscheduled, we're just going to send them money whenever we feel like it. We're dumping it in at some point throughout the year when we get cash. So we've got some people who have plenty of money and they know exactly when it's coming in and they can do on that regular schedule. I have other people, commission earners, they don't know when they're going to get their big heyday. Real estate investors, real estate agents, life insurance agents, insurance agents in general, like people who get paid on commission, it's like you make a lot of money in 1 month, you make a lot less in another month. So it works out really good when we design the scheduled payments to be very small, but they can dump in large amounts whenever they want to. It's a really great way to do a design on some of these things. It gives a ton of flexibility for people to be able to contribute. And my number one thing when it comes to deciding which carrier to go with is flexibility. How much flexibility do you need? We want the carrier that we choose to have the ability to meet that flexibility needs so that you can contribute as much as you want to these policies. It doesn't do as much good to go with a carrier that's really strict but limits you to contributing a tiny amount, even if they might, that tiny amount might generate more in returns than a tiny amount in another flexible company. But with the flexible company, you can put in 10 times as much money because of the flexibility. You're going to end up with way more cash value down the road if you could put in 10 times as much money as opposed to a little tiny amount that might earn a slightly better dividend or a slightly better interest rate. So a lot of things to take into consideration there. Good questions.
I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.